Good morning and welcome to the Alpha Pension Group Retirement Recap. With me is our Chief Investment Officer, Rob Milas, and one of our great consultants, Nicole Ryan. So Rob, you've had this theme of having animals in to sort of keep us in the theme with the markets, but I think you're cheating this week. I see puppies. I think you just threw that up there just to have, just to keep the streak alive.
You're not supposed to reveal my secrets. Yesterday was National Dog Day, so I did choose to keep the animal theme going. But there's no dogs in the market these days, boy. It continues to really rip. And again, we continue to get the questions: how could this market continue to rip when things are so bad out there economically? And the reality is again, just to remind folks that the market is a discounting mechanism of future action. And so what we are seeing is some recovery in some of the economic numbers. So we're seeing durable goods orders were up 11% in July. That beat the consensus expectation of 4.8% soundly, obviously. We've got new sales of homes at a 13-year high. And also just, kind of a conglomerate of all of the indices, kind of are pointing upward. And so I think that's what you're seeing, part of the leg of the up market. The other part of the leg of the up market, again, is this whole idea of liquidity and the Fed being willing to throw just about anything and everything at this market in order to get it to continue.
Awesome. And I take it back. You worked the animals in there nicely. It wasn't just a placement for no reason. So well done, Rob. Nicole, you're going to talk about something that's pretty interesting too. I mean, we focus a lot of time about accumulating wealth while we save in retirement. But then there comes a point where, how do you live with income in retirement? And I know there's a lot going on with the conversation about that, but also disclosure. So I'm going to turn it over to you so you can walk us through that.
Thanks, Rich. So, Rob, it seems like the markets have been really busy and the Department of Labor has been really busy this year as well. So we've seen preliminary proposals around ESG or environmental social governance funds. We've seen talk about private equity and 401k plans. And now, as Rich mentioned, we have a new interim final rule on lifetime income disclosures for 403b and 401k plans. So all plan participants will now annually receive a statement from their record keepers that shows them what they can expect to receive monthly, again, if they purchase an annuity. So they're sort of changing that stream. Instead of accumulating wealth, they now start their stream of payments. And this is great news because I think this will really enable employees to better plan for their future. If they have a solid understanding of how much money per month their retirement balance translates to, they'll have a much better understanding of whether or not they're prepared. Are they saving enough? Are they asset allocated properly? At what age could they potentially retire? So this entire process should become much easier for employees, plan participants, and their beneficiaries. This interim ruling from the DOL outlines the calculation methodology that they want record keepers to use, as well as outlined some investment assumptions. And if the record keepers go along with these suggestions from the Department of Labor, they will receive broad fiduciary relief or safe harbor, which basically just means that they will not be held liable in the event that participants are unable to purchase equivalent monthly payments when they retire. So basically, the providers need to present these illustrations. But if they don't hold true at the end, if they used the appropriate assumptions, they will have safe harbor from the DOL. So again, I think this is great that everyone's going to be receiving this information. It's important to mention, however, that plans, although they're obligated to present these illustrations and present this information, there's no requirement for plan sponsors or record keepers to actually make in-plan annuities available. The requirement is simply to help better educate the employees about what their balance might translate to when they enter retirement.
And you're right. The Department of Labor has been busy. The markets have been busy, but also legislatively, we've been busy as well. So I'm going to talk about two things: plan amendments and RMDs. that are a direct result of the Secure and CARES Act. So in the context of RMDs, here's what it means. The year 2020, believe it or not, is a non-RMD year, but it is a little bit confusing. So here are the ground rules. If you're 70 and a half by the end of 2019, you can skip 2020, but you must take an RMD in 2021. If you were not 70 and a half, you simply take your RMD April 1st in the year after you're 72 years old. So that is a little confusing, and it will remain confusing, but the takeaway really is that there's no RMD due this year, and you should consult with your advisor or your tax consultant to get clarity as to how you should handle that. One last thing on RMDs, these new rules do not apply to defined benefit plans. This is just for 401k, defined contribution, or profit sharing plans. On to plan amendments. So again, with the Secures Act and the CARES Act, your plan document must be amended. And it differs depending on the type of plan document you have when you need to do that. So if you have a specific customized plan document, the rules will be different, and you must ask your consultant or your advisor or your third-party administrator when those amendments are due. Lastly, I'm going to leave you with this going into the weekend. This is tax-free weekend here in Massachusetts anyhow. We work with a lot of small local businesses that offer retirement plans, and they're great companies, and they need your support. So this year, you don't even need to get out there, right? You can socially distance, go online, and support those clients and get a nice little tax break as well. So as always, thanks for joining us. We really appreciate your time. Check us out on LinkedIn and Twitter. We have a lot of great information, and we will see you next week.